I want to welcome everybody to today's webinar event. I am your host, Sean Kozak, and I am the founder of NeuroStreet's Trading Academy. Today is one of my favorite absolute topics to teach, and it's actually one of the most sought after concepts in financial trading, especially for day traders. And that's the topic of becoming an order flow Jedi master, right? I mean, ultimately, there's a lot to learn with order flow. And I've developed products for the space of order flow in its entirety so that we can really kind of learn how to profit from the identification of data. And I'm really excited for those of you that have never been to an order flow event of mine, sit back and enjoy the ride because we got a lot of stuff to cover. It's more of a workshop than a webinar. I want to teach you guys concepts, actionable concepts that you can use to be able to go in and actually exploit opportunity at the right locations. The main objective here is that if you are using order flow, then we can help capitalize on making you better at it. And then for those of you that are absolutely new, looking at why the order flow concepts are quite important. Now, before I go any further, a couple groundkeeping rules. One, we are recording the event, so you can definitely get access to that when we send it out via email after the event. Two, if you have questions, please type them in the chat box. I am not going to ignore you. So if I don't see it right away, it's not because I'm not responding to you. I will get to them. It's just I have a lot of topics to discuss. So just kind of take notes, and then we'll stick around at the end and we'll go over questions after. And if you have to leave, rest assured, just the fact that you're here already speaks loudly, leaps and bounds of your attendance. We appreciate your attention in our business, and we're here to help and serve, right? So that being said, traders, let's jump in here and kind of get started. Need to cover a quick disclaimer because obviously I'm not a broker or a CTA. I'm not here to give you advice. And I really have no interest in the outcome of your trade. So if you do place risk capital in the markets, please do so at your own discretion. Past performance never guarantees future results. Okay, so we know we've all got that in there, but it's super, super important. And I just want to make sure that, that you guys understand that. So we've got an agenda. What I want to do is I want to talk about the order flow process for everybody that's kind of getting started. You've probably heard me teach this before, so if you have, just kind of sit back. We'll go through it quickly. I really want to spend time into the signals. I really wanted to spend time in the aggression. And my favorite part is the entries and confirmation. This is brand new topics. We're going to be talking about hunting for trades. I want to show you the two trades that I took today and how we used order flow in our trade room to take those for confirmation entries. Both of those trades were really big winning trades, so they were successful. Green on the screen all day long. The concept is, why would we want to use order flow to confirm our trades? Well, there's a lot of mixed reviews on that, and I'm here to kind of sort through the noise and kind of give you some context so that you guys can take this information and leverage it to your advantage. We do have a discount running. We are coming into the holiday season. So if you are planning on taking advantage of any sales, this will be the last round for the year. So definitely, if this is of interest to you and you are interested in using the tool sets, rest assured, we've got a very hefty discount for you guys if you are planning on using the software. So that being said, guys, if you don't know who I am, my name is Sean. Been around for a long enough time. Most of you guys have been to at least one of my events. If you've never been to a webinar of mine before, welcome. You're in the right place. We do care about your success. Not here to give any fluff or snake oil. Don't believe in it. I don't think there's any room for it in the markets. There's already enough challenge as it is. If you want to speak to our traders, you want to speak to my team, or if you have any specific questions, we're just an email or a phone call away. We are here to help you, and trust me, we do care. So the main objective is for me to serve and to help you become a better trader. And today we're going to do that through helping you understand order flow and mastering order flow and volume. And the main objective is for you to learn how to use it and efficiently, exploit profitable opportunities. So the main concept then is, what is it, right? Like, what is the purpose of order flow? And, the truth of the matter is, when I first got turned on to order flow, I was so overwhelmed by it. I was like, wow, man, like, I just want to look at a price chart, give me a candle, give me an indicator, show me where to buy and sell, and I'll be off to the races, right? But in reality, there's a whole lot going on behind the candle that a lot of traders don't even understand is happening. And it becomes an overwhelming process if you learn it from a difficult process, right? Like, if somebody tries to teach you order flow in a difficult way, it'll make it feel so overwhelming that it can never be taught efficiently. And therefore, the mind will shut down. We won't receive the information properly. and it'll become an overwhelming experience, right? It's kind of like going into corporate finance. When I was studying finance back in the day, I used to love accounting, and I would go into corporate finance for mergers and acquisitions, and my head would flip around on its axis. I just never wanted to go to the class, even though I was good at it. It was just so overwhelming, right? And order flow can be like that for a lot of people. Order flow can be like that for a lot of people. And my objective is to help simplify the noise. After 10 years of being in this market space, I can assure you that I'm going to teach you what to look at that's important, and you can leave the rest at the bank. Okay. So the main objective is to kind of go into the data. A candle is not just a candle. There's a lot of information inside price action. And in order to understand that, we need to understand the order flow process. The first part of the order flow process is the inventory. The inventory is the resting order sitting above and below price. So if you've got current price sitting here, you're going to have sell orders above price. You're going to have buy orders below price. That is the step one called inventory. Now, the thing about inventory, okay, the thing about inventory is that nobody knows if it's going to execute or not, right? The inside bid and ask is here. Nobody knows if we're going to execute above or below price. In fact, a lot of times what traders can do is they could just pull their orders, right? So inventory is also level 2. So what you guys want to understand what's going on here is inventory is level 2. It's called depth of market. And you can sometimes see this on the dome, depending on what data feed you have. But ultimately, this is depth of market. Now, let me kind of explain my experience with depth of market. It is absolutely rendered useless in thick markets. It's absolutely rendered useless in thick markets. Let me repeat that. If you're trading the S&P, if you're trading the NASDAQ, if you're trading bonds, good luck. There is so much liquidity in those markets, it means next to nothing because there's no impact in the level 2. But if you want to trade thin markets like crude oil, gold, Russell, okay, small cap stocks, not large cap stocks, small caps only, thin markets, less than 50 million float. Those things are going to move and groove and pop in level 2. That's when inventory becomes important. It's the thick markets that they just control so much market flow. It's just there's no edge to it. And even when you think of breakouts coming, it's not. And that's the thing. That's why if you see high volume, low volume to range ratios, like how many of you guys have ever seen the Russell just rip, like just take off out of nowhere? Same with gold, same with crude. It just out of nowhere just takes off. That's because it's a very thin market, and a lot of times what'll happen is it'll just start trading really fast in one direction, and nobody understands why. Well, it's just because it's got a very thin market to range ratio. And so that's when level 2 becomes very important, okay? So when you go from inventory, technically, if you have data feeds that will give you level 2 data, you'll normally see 1, 2, so that'll be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 levels deep. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 levels deep. If you're using level 2 data and you have depth of market, then you should see numbers all the way up the ladder in the dome. If you have level 2 data, you have to subscribe to it, okay? I don't think if you're not trading thin markets, if you're trading small cap stocks, you need it. If you're trading gold, Russell can be very efficient depending on how the strategy that you're trading, okay? But if you're trading thick markets, the dome can be quite overwhelming. Then the only thing that really matters is the inside bid and ask. And the inside bid and ask is what executes trades. So as soon as one of these orders above price or below price gets executed in the market, then what happens is it moves over here into the order book, which is the ticket. It's the time and sales. It's, if you've ever been to a grocery store and you buy food, you go to the cashier gives you a receipt. The receipt says what you paid for, the time you paid for it, the date, the price, the change, everything. It's a receipt book. That's all the time and sales is a giant receipt book kept by the market for data. And what ends up happening is traders try to make sense of this. Traders are like, I got to execute on the dome. Okay. Some traders prefer it. I've yet to find a lot of very successful traders trade the dome. Some traders do, but not the majority of traders. And then I've seen a lot of traders try to read the tape. Now, the tape can be very, very, very overwhelming. You've got a whole bunch of numbers coming through. You got a whole bunch of colors. It's like walking into a casino and you get all the flashing lights going off and it hits your endorphins and your eyes are flickering. And next thing you know, you're ready to make an emotional decision and you don't even know why you're in the market. Tape reading is a skill set that takes years to master. And my experience with tape reading is that it only really matters on key areas when the market's breaking out. You should see floods of orders coming in, really, really, really big block trades coming in. And I designed a product that integrates into our print profiler software that will look at the size of block trades and it will tell you when it's relevant. So I'm going to show you a signal that we've built that will tell you how to simplify the tape so that you only pay attention when it happens. So then you ask, well, then why are we looking at all this stuff? Well, that's a really great question. In fact, I would prefer that we don't. I would prefer that we just stay out of all this and make it a little easier. We transfer the data to the charts. We transfer the data into the candles so that you don't have to sit there and try to be the master of the market for no reason. And the concept is teach you how to read the candles rather than teach you how to read all the information in the numbers. Okay. And so what ends up happening is every single candle is divided into two. Okay. And just like this 9 is compared against the 2 diagonally, 2 would be compared against the 9. 5 would be compared against the 15. 25 would be compared against the 56. Those are diagonally. This 4 is compared against this 0. This 15 is compared against this 0. This 159 is compared against the 182. So right now on the current candle, we'd be measuring like this. You say, well, why is that important? Because buyers need to go to the asking price and sellers need to go to the bid price. And that's how the market reads depth of market. Buyers need to go up, sellers need to come down to facilitate a trade. And so what we do is we take the data and we put it into the candles so that we can get rid of this, we can get rid of this, and we can simply just look at our charts. So let me kind of go into detail. This is the S&P. Right now, our software is reading inventory above and below price. That's the level 2 window. It's reading this depth of market here and here. It's reading this. The left side is the buyers. The right side is the sellers. So technically, this seller is measuring that volume graph, and this buyer is measuring that volume graph. Now, the reason I'm sharing this with you is because some traders like to see that. Right now, I can tell you where the big buyers are sitting on the bid right here. I can tell you right now where the big sellers are sitting on the ask right here. It's the most important part on the ladder right now. But you see how quick it moves all over the place? To me, it's really not really identifiably strong asset for trading unless you're just a tape reader. If you're just a tape reader, it's different. If you're just a level 2 trader, it's different. But like I said, on the S&P, it's really, really difficult because the market's going to sit there until it doesn't, and it's just going to chop you around and chew you around until you get to key areas. So my suggestion is just understanding that we take this dome information, which is fed from the level 2, which transfers to the time and sales, and we move everything into your chart. Does everybody understand that? Because when I first started learning all of this stuff, it was like, man, I got to learn the level 2. I got to learn the dome. I got to learn the time and sales. You don't need to learn any of it, actually. It's absolutely useless. I'm here to tell you that it's simple. It's so much more simpler. And we're just going to make your life a whole lot easier just by doing this. There, you just need to learn how to read this. Because we've done it all into the candles. We've done it everything here so that you don't have to worry about it. And if you're trading a thick market, then we just go in here and turn the inventory off. Not useful. Now we're left with an order flow chart. How many of you guys think this is a little easier to read? You're not looking at all the flashing bells. You're not looking at all the ups and downs, stuff like that. Give me a yes if you think this is probably be a little bit easier to understand. Okay. Absolutely. So let's start with the first process so you can start understanding what the information is telling you. The first thing I want to do is I want to help you understand tape reading. Tape reading is the time in sales. So instead of us using a time in sales window that's got all those times and like all that information, remember the receipt book? Instead of us reading the receipt book, what we do is we call this tape reading and aggression into the candles. So what I teach traders to understand is how to read the left or the right side of a bar. So what I want you to do is just picture every time you get a price candle, it's split into two. Whenever you're reading information on the left-hand side or reading information on the right-hand side, it's understanding the tape. Now, what we want to do is we want to know who's aggressive. Are the buyers aggressive or are the sellers aggressive? And the way that we understand that is we create what we call a multiplier. You can change this to like 3 times, 5 times, 10 times, however much you want to. But what I want to know is that whenever the sellers are 3 times larger than the buyers, they're going to come down and they're going to hit the bid. Or whenever the buyers are 3 times larger than the sellers, they're going to come up and hit the ask. This is going to signal market order execution, not limit. So when you start to see aggressive candles like this on the right-hand side with highlighted text or dots, or you start seeing aggressive buyers with like highlighted text or dots, you can control the colors however you choose to. You might like pink rainbows, you might like yellow dots, whatever you want. But anytime there's highlighted information on the left, that means that the sellers were 3 times larger than the buyers, and they're hitting the market on the bid, which means that's aggressive selling. Market order aggression is going to cause the market to flush down. Market order buying is going to cause the market to flush up until it doesn't. And we're going to talk about that. So what we do is we highlight the aggression. Some people will call this stacked imbalances. Some people will call this order flow imbalances. To me, look at it from what it is. It's aggressive data coming into the tape. It's aggressive. Market order execution is aggressive trading. Limit order trading is passive trading. So whenever you see aggression step into the tape or aggression step into the candle, it's because market orders are flooding the market, and it's going to cause aggression in the market. Now, give me a why that everybody understands that. I don't like to transfer to the next topics until you guys understand this. Okay. So what I'm going to do is I'm going to go into the charts, and we're going to just go and we're going to look at some of the information. Okay. So let's just go here. Let's take a look at the lows here for a second today. So today, when the candles were trading down, okay, the candles came in, they put in a lower low, and then they rotated. Do you notice here how you can start to see aggression coming in here? I just have dots on my charts because to me, I don't even think reading the numbers is important. So when I start looking at the numbers, I'm like 90% of the traders that don't want to have to learn all that stuff. I would just turn the numbers off. If I'm not using them, turn them off. And now all I have to do is just look for the dots. Just understand what the dots are telling me. The dots are telling me that that's aggressive buying coming into that candle on that rotation. And then they consolidate for a little bit of period of time, building a bigger position. And then what happens on the breakout? Aggressive buying. You can see it when all of the market orders trigger the breakout. Why? Because all the stops are getting hit above the range, and then all the buyers step in to buy the breakout. So all we're doing is we're just showing you how to read that information into candles. If I go in and I look at the numbers so you understand what that's telling us, 285 is definitely larger than 3 times 1. 148 is definitely larger than 3. 302 is definitely larger than 3. That's aggressive. 11 sellers to 250 buyers. 13 sellers to 321 buyers. The dots stand for either buyers or sellers 3 times larger than each other. So if the market's trading up this way and you start to see all those dots on the right-hand side of the candle, that means the buyers are becoming very, very aggressive, and they're going after the buyers are attacking the ask by 3 or 4 or more times. Okay. Now on the sell side, right up here, you can see this. The market comes in, puts in the high, drops down, pulls back, and then they drop here. What do you see on this drop? You see all this yellow dots coming in here, flushing the market, okay? This to me is aggressive selling. This is market orders triggering the market. This is not limit orders. This is market orders. So what ends up happening is you can see that every one of those dots is a lot of market orders on the sell side. Remember, left-hand side aggression is the sellers coming down to the bid. Right-hand side aggression is buyers going to the ask. So whenever you see the candles on the right-hand side giving you dots, let me just turn off the numbers here for a second so you guys can see it. Whenever I've got dots on the right-hand side of my bars, you can make the candles a little wider if you choose so it's easier to see it. Whenever the candles are giving me a lot of dots on the right-hand side, that's aggressive buying. Whenever you're getting a lot of dots on the left-hand side, that's aggressive selling. Does everybody understand that? Give me a yes. Now, the reason this is important is because that creates supply and demand. So aggression is market order aggression. So it creates levels of supply or demand in the tape. And a lot of times when price comes back to it, it can create actionable opportunities. Now, we're not going to spend time in this webinar today teaching how to trade supply and demand imbalances from the tape, but I can assure you our members area and our usage training videos have a lot of information on that. And I would refer this to be more of a scalping strategy than more of a level strategy. So if you are going to trade order flow imbalance, my experience with it has been it's much more for reactive trading, meaning you'll get nice reactions out of it, but that's not where the big banks are putting on positions. So if you're an order flow scalper, it can be great for a few ticks, but leftover aggression is not built-in sentiment. So I just want you to understand that this can be really great opportunities. So let me show you this. Turn on the zones. Tested zones. Broken zones. Take a look at when price got back up to these levels here. There's buying and selling demand levels in the print. So when price gets up to them, you can see we get reactions out of this. You get reactions out of this, but it's not really the concept that I want to spend today. I don't want to spend time teaching supply and demand balance today trading. Like you can go back and see that, you know, yesterday when we came in and we hit some of those levels yesterday, we got a reaction, right? We definitely got reactions out of these levels, but that's not the strategy I want to teach you guys today. I don't want to teach you guys something that I find it's okay. So my experience with supply and demand tape imbalances is that they're okay, but they're not amazing. And I want to teach you stuff today that is amazing for trading, not just okay. Okay. And I think that's just my experience talking a little bit is important for me to kind of sort through the information with order flow. Remember, the title for today was Become a Jedi. Jedis aren't trading tape imbalances. That's 5 years of order flow experience coming at you. So what we're going to do is we're going to talk a little bit about the deltas. Now, here's a little bit of a history on delta. Delta is the net relationship to all the buying and the selling in the candles. So let's say you get a candle and you've got all the numbers on the left-hand side and all the numbers on the right-hand side. Well, if you know anything about a fair market theory states that there's always an equal buyer to every equal seller. Well, that's not always the case. because if that was the case, price would not go up or down. So what ends up happening is we'll normally have a net relationship. That net relationship is either going to be positive or negative, which is going to create either positive net delta or negative net delta. And the only thing that delta tells us is the net relationship to all the buy orders versus all the sell orders in a candle. Now, here's the thing about delta. If delta was that easy, it would be the holy grail of the market. If delta was so perfectly simple that all you needed to do was look for net buy order flow versus net sell order flow, everybody in their monkey would be millionaires because delta would be the holy grail. The problem with delta is not a lot of traders understand that sometimes limit order execution can mess the delta up. And that's why delta is not the holy grail. Delta can be a great tool for trading, and it can be a really great tool for understanding, but sometimes you'll see prices go up on negative delta. And sometimes you'll see prices go down on positive delta. You say, well, what's going on here? Limit order execution versus market order execution. And I'm going to teach you how to see that here because I've got a picture that explains this to a T. So stay with me here, guys. I'm just trying to teach you guys some concepts. Let's take a look at the deltas. Okay. Take a look at the deltas. Take a look. You got an up bar here with negative delta. You got an up bar here with negative delta. What does that mean? The market's absorbing the selling. The market's absorbing the buying. Absorption is stepping in. And we should start to see sellers roll this over a bit. And we're going to talk about that. We're going to talk about that here today. But the main objective here is I want you to kind of know that the market is going to give you tools to read if you have it. So what we're going to do is I'm going to show you the print profiler allows us to be able to control the order flow, control all of the bid and ask imbalances. I can turn all of the candles on and off. I can go in here and use the delta to my advantage. But what's more important is what we can't do. So when I look at building software for trading platforms, I've built about 50 indicators for 3 different platforms. And what I always try to look at things is like, you know, if I'm going to build a tool and I'm going to use a tool, why would we use it? Well, there's things that we can do ourselves as traders, and there's things that we can't do. Okay. I can guarantee you that you're not going to sit here with a calculator and a magnifying glass and look at all of the price data coming in from the time in sales and identify hidden opportunities in the market based off order flow sequencing and based off of, you know, this type of information. So what I've done over the past several years is we've added signals, we've built algorithms to read the numbered data so that it can tell us better opportunities. Why would this be important? Because the objective is to let the software do what we can't do. There's things we can do. We can do our analysis, we can plan the charts, but there's no way that you or me or anyone at that matter can access this type of data fast enough to make decisions. And order flow is ultimately built on the premise for more so market timing. You're not going to see an institution using order flow on a 60-minute chart. You're not going to see any big traders taking on big positions using order flow to time their entries. These are banks. They don't use that stuff. And if anyone tries to tell you that they don't, that's a marketing gimmick. I don't need to tell you that. Banks are not using order flow to time their entries when they're trying to put in positions with 500,000 contracts. Okay, let's just get right down to it. So what I'm here to tell you is that as retail traders, we want to be able to look into the information that they're showing us so that we can make sense of the information. Right, so that we can actually go in and start putting this information together. Now, we've had these signals for some time now. We had trap traders for some time. We've had delta divergence. We've had a combination signal. Some of you probably seen me present an event on this. These two are the money shot, man. Like, it took me a long time to build these and to figure out how to do it properly. And when I did, I unlocked something that I didn't think was possible because we built a quant filter. These are built off quant analysis. So what I did was I said, I wanted to understand how to see when the market is going to rotate before it happens. I need to go in and I need to understand how to identify block trades, but I can't have every market treated the same. Like the S&P trades different than crude. The euro dollar trades different than the Swiss. I can't go into this information and I can't treat each market equally. So what we need to do is we had to build an algorithm that detects each market independently so that we could make sense of the right information. Because order flow absorption on crude oil is different than order flow absorption on the gold market. Block trades on the S&P are like 50 to 100 lots. You put a 50 or 100 lot into the Russell and they'll probably put a circuit breaker halt on. Right? Like everyone's gonna be, who is this guy? Right? And so that's why I wanted to share with you today. We're going to go quickly through these signals, and I'm going to spend a lot more time on these two because I think that's the money shot that's really, really the most important. So the first one I want to teach you is about trap traders. Trap traders are going to signal a cue on your chart. You're going to get a buy signal, you're going to get a sell signal when the market trades up, and then all the buyers get exhausted at the highs. Then when the market trades down, all the sellers get exhausted at the lows. Inside of this information, as the market's trading up, our software looks inside the tape and it tells us when the order flow is getting exhausted on the buy side so that we can see that the buyers, even though they're pushing the market up, they're pushing it up on less and less steam. The orders are dropping. There's no way we can calculate that manually. Like, we wouldn't want to even try. As a human being, it's not even possible. Like, for me to sit there, 351, 349, like, you've already lost me. Right? Same thing to the sell side. Market's dropping down. As it's dropping down, we're going from 169 to 90 to 13 to 12 to 11, and it flushes. So our software will signal when the exhaustion is happening so that you understand when you're coming to the end of a move. So that's really good if you're in a pullback, right? Like, let's say you're trading a pullback and the market's pulling back. This would be a great opportunity to see when the market pulls back because you get exhausted order flow at the lows before the market trends up. So if you're a trend trader and you like to trade pullbacks, this is a really, really good signal to time your entries for pullbacks. Okay, very, very good information for pullbacks. Here's another example of diverging delta. How many of you guys have heard of divergence before? Anybody here ever heard of divergence before? Divergence is normally meant by, prices making higher highs and momentum is making lower highs, right? That would be considered bearish divergence, or prices making lower lows, momentum making higher lows, right? That'd be considered bullish divergence. Well, that's normally with momentum. What we're doing is we're doing it with order flow. So what we do is we look at prices going lower, and then it reverses after making lower lows on positive delta. Prices going higher, prices reversing on negative delta after making higher highs, which means the market's going up on negative delta. The market's coming down and transitioning on positive delta. This is also a really good signal for rotations. It's a really good signal for timing tops and bottoms, especially in range-bound markets. Absolutely, everything we do is recorded. You'll definitely get access to it. But what I like is I like to combine them because I'm all about stacking as much evidence into a signal as possible. If you're going to be a day trader, if you're going to scalp the market, if you're going to see things, right, this is important. We can look at delta divergence and we can look at order flow exhaustion on the same bar. Now, there's no way the human mind can find this information when the markets are trading. Like, I couldn't, and I've got a lot of experience. I know that somebody that's just getting started would never be able to see these patterns on a chart, and you don't have to, because all we do is we turn off everything. Turn off the delta, go into our signals, trap traders. Excellent. That is telling me right here that as the market's trading up, the buyers are getting exhausted at the highs. As the market's trading down, the sellers are getting exhausted on the lows. That's what we do with the signals. Now, what we're going to do here is we're going to kind of stack the odds a little bit more in our favor. We're going to go and we're going to turn trap traders off. Let's go take a look at delta divergence. Delta divergence happened at the lows in here. Okay. Now let's go in and turn them on as a combined signal. delta divergence off, combined signals. Those are powerful signals because that's the trap trader and the combined signal together. Okay, but it's a preference. So what you can see, we can see these big rotations in here. Now you can see when the market gets, it depends on how you use the signals. I don't rely on just trading signals alone. I use them more for trade management purposes than anything, right? If I was trading, you know, up here and I was trying to get long and I started to see all those signals come in, I wouldn't trade it, right? And a lot of times you'll see these coming in on bounce trades. The big thing here is you can see on the rotation today, the S&P rotated, and we got trap traders and deltas coming in as the market started to build their position. That's exactly what was happening. And so what we're going to do, I'll go over questions after, guys. I've got too much to cover in an event. We'll go over questions after, guys. No, I'm not ignoring you. Okay. So what I want to do is I want to just kind of talk a little bit about, these are really, really great signals, especially if you're going to trade on, say, range or Renko charts. These are very, very fantastic. I prefer those signals. So trap trader, delta divergence, okay, and then combined signals. I prefer to trade those on fixed range candles. So let me just explain this. I'm giving you golden nuggets here. Fixed range, which means range bars, Renko bars, anything where the candle is the same size on all the bars. When you're using time-based charts, volume charts, Heikin-Ashi, tick, anything that every candle is a bit different, I would not put too much of an emphasis on those bars, those signals. I would put more of an emphasis on what I'm going to show you next. So let me kind of repeat this. If I'm trading a 5-minute chart of any market, I'm not going to rely so much more on the trap traders and the combined signals. What I'm going to do is I'm going to teach you how to read the print like a Jedi. So this is my favorite topic. And the reason this is my favorite topic is because I can tell you the power of this and what it's doing. So in order for us to really understand the market, we need to understand who's trading it, right? Is the market made up of retail traders or banks? I know it's a rhetorical question, but humor me. Banks, right? Institutions, big money. So what I wanted to do was I went back to the drawing board and because I've been trading order flow and looking at order flow for a better part of probably 7 years. And the big thing is understanding key levels and when they're doing things. So one of the things I wanted to do is I wanted to build an algorithm, and I did it successfully. So this is why I'm excited to share it with you, is that we now can assess when big money is stepping in to absorb the order flow. Meaning we're able to identify the average order flow size that is normal for your market. And then we're also able to identify when the order flow size is abnormal, meaning the banks are now putting an interest in. So let me kind of explain what this means. You're going to have the market trade all over the place. Okay, you're going to have the market trade all over the place. But that doesn't mean the banks are interested or big money's interested. So what we're going to do is I'm going to turn the print on. Okay. We're going to go in here. We're going to turn things on. Okay. And I just want to kind of drive home a concept for a second. Let's go over here. I'm going to turn the dots off because it's not necessary. So if I'm looking at a chart here and I've got a bunch of candles, okay, I've got a bunch of order flow. What we do is we call this big money print. And what big money print is, okay, big money print is an algorithm. And what we're doing is we're actually kind of going in, and if you look at this, you see where it says average big money bid and ask right here. This is a really unique algorithm that we built that scrapes the time and sales essentially. What it's doing is it's scraping this right here. It's scraping the receipt book, which is a really, really significant piece of information when you have an algorithm do it for you. And what we're doing is we're able to see that, okay, big money print right now, that the average ask size Okay, the average ask size is about 375 contracts. So that means that this market is normally trading on average about 371 to 375 contracts on every ask price. So what that means is we go back over all of the candles, and if you look here, that means all of the price levels here, on average, every one of them is 371 contracts. Okay, you guys with me? This is very, very important. Then what we're doing is saying, okay, the average bid is about 416. So they're saying, okay, all of the orders on every single candle, okay, is about 416. Nothing. The dome is level 2. It's a different way of reading it, Martin. Now what we go in here and we say, okay, if I know that this market on average is approximately trading about 400 contracts, right? Like the ask is about 375. The bid's about 416. You round that up and down to, 400 and change, right? Well, that's the normalized order flow for this market. So what we do is we take a multiplier to identify when big money is stepping in to absorb the opposing side of any of that. And we call that big money print. And so what big money print does is I can go and I can turn big money print on here. And I can tell you that when this market was shooting up here like this, look at this candle right here. This market shot straight up here like this. That is absorption. That is big money stepping in to stop the buyers from going any further. Very, very big orders went in there. Okay. Very, very big orders went in there. Now, I'm going to show you what's more important. Take a look at the open. Take a look at what you're seeing off the open. All of the market open. See all the big orders coming in off the open? And there's a big battle. There's always a battle off the open. Who's going to win the open? Who's going to win? The bulls or the bears, right? The buyers or the sellers? Well, what's more important is what's the overall direction of this market? Uptrend, right? So if this market's in an uptrend, essentially, who do you think we want to be paying more attention to? Big money on the buy side or big money on the sell side? If we're in an uptrend and the market's going up, what do you think? Well, it depends. Maybe we want to, if we're a counter trend trader, then you're going to be paying attention to resistance on the sell side. If you're a pullback trader, you're going to be paying attention to when the market shows you that the market's coming in and it's giving you big money on the print. So if we come in and we assess what happened down here, when they flushed in here off the open into the pullback, I'm going to show you how to read this. As the market's trading down, this is big buyers stepping in to absorb that flush. You see how all of the big buyers are on the left-hand side or right-hand side and the sellers are on the right, on the left? You see here how that's on the lows like that? What we'll normally see is the market will come in, the absorption will happen, and then you'll normally see market orders come after it. When you see that, that's because the market's getting ready to lift. So whenever you can take big money print like this in a key area, we were in a key area, we were pulling back, we pulled back, market pulls back, then I turn on the order flow aggression. And where did the order flow aggression come in right after that happened? You see this? We get the drop, big money stops the market. Everybody that knows anything that's going on in the world, anybody that has any information on bank platforms or anybody that really is the market, once they see that happening, they're like, okay, now we just want to see if the market's going to engage. They engage on that. You can't have market orders coming in off the low. If you've seen a bunch of market orders here, that would be profit taking. But we don't. We see the market make a lower low in price only to have the big institutions absorb the market. And then you see all the smart traders that are like, okay, they're stopping here. Look, you didn't have any absorption here. You had absorption here. There was nothing. It was thin. They flushed down. There was no absorption here. There was no market orders following absorption. And then as soon as the market puts in the lows, it flushes, and then they lift, they consolidate, and then all of a sudden you get the breakout with more market orders. What do you think that is? That's the bank setting the low on the pullback. Really smart money's getting in here now because they've got access to that information. All of the trend followers, the retail traders, are like, they're stopping the market. Let's get in. And this is how you start to read this information a little bit more efficiently, because now you can see what's happening. As the market trades up to this level, big resistance. What's happening at the highs here? Absorption steps in. What we want to do is we want to see market orders come in after that. We want to see absorption step in at resistance levels, and we want to see market orders hit the bid, because that's going to tell us that the sellers are trying to step in. The buyers come in for one last attempt, and then the market flushes. What happened at the high? Sellers came in to absorb the buyers at resistance. So what you want to do is you want to look for sell absorption at resistance, and you want to look for buy absorption at support, because that's going to tell you that the market is giving you the cue. So let me kind of give you a little bit of a Cliff Notes version of the simplicity of this. You've got a support level like this. You got a resistance. I don't care if it's a support level you want to go long on a reversal, if it's a support trend. Okay, we'll do three scenarios. Reversal traders coming down, boom. What you want to see is you want to see buy absorption step in to take the opposing side of the sellers. You'll see that in the print. And then what you want to see is you want to see the market follow with market orders. That's when you know the buyers are stepping in to stop the market. Market trades up, pulls back into support. You want to see buy absorption on your pullback. That knows that they're stopping the market, support's holding, okay? When you get up to a resistance level, you want to see sell absorption step in, followed by market order aggression here. Because that's going to tell you that the institutions are stopping the market, and then all of the herd followers, me included, you included, because we're the ones waiting to see what's happening, everybody's getting in. If you try to step in without institutions showing you that they're absorbing the big flow of money, you're going to get run over. Give me a yes that kind of makes sense to you. And our software will identify it, because you can't treat every market the same. I'll give you an example. Let's go look at the Russell. Let's take a look at my trade today. Now, I was using a different strategy, but I used order flow to time this. The market flushed off the open, yes? The market flushed. Now, I was trading an auction level, so just a word of transparency. This was a value area low on the auction. I was trading the value area low of a profile today in our trading room. You can see the open. Look at the candles, all of the order flow. Now, let's take a look at the average side bid and ask. Look at the average ask size is 23 contracts. The average bid size is 23 contracts. The S&P is 400. We cannot treat the markets the same. They're completely different markets. So our software will identify the aggressiveness in the absorption. Look what happened here. Do you see any market orders coming in here and triggering after that rotation? No. Do you see any market orders coming in here? Hardly any. You coming in. What do you see right there? Absorption, 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 absorption. Market accepting balance and lifting. I took the trade there. We were waiting for more timing, and I got out here. on the way up. Okay. It was a nice trade. It was in and out. It was quick and easy. Okay. I took 2 targets on that trade. We'll go take a look at the NASDAQ on this. Take a look at the NQ. Beast of a market. This is fun. NASDAQ's a very big market. What do you see here? This was also a value area low for those of you that are in my trade room this morning. Look at this. The market came down to a value area low. This was the value area low today on the auction that we had, or we wouldn't have traded it. Okay. The market came in here. We entered on a delta flip. Just to understand what we did is we entered on a delta flip. And I entered on a volume rotation. So there was a little bit of a different edge to what we did, but I just want to explain what happened. Look at the absorption coming in here at the lows. Okay. What ended up happening is they came in to retest the rotation, and then we ended up getting into that trade, and then the market orders came in here. Boom. Now I took my first exit there as the market was lifting up. They came down to retest again, and they hit my break even, and then they ripped it again. Do you see what's happening here? What do you think is happening as they come in on the market order on this side of it? That's where they stop the market. That's where they're coming back to retest the market. That's them proving that the support's holding, and that was why the market held this morning, right here. Now I'm going to turn off the candles, and there it goes. Okay. Now, I want to share with you something else. This can be a very powerful edge as well. Block trades. Now, this is just as important as the last discussion. Okay. Block trades are big blocks going off in the market. Big orders. Like, you see this 22 right here? That would be considered a block trade if the market felt that that was a big block right there. So what we can do is we can set the software to identify big block orders in the market. But here was the problem. For years, nobody would understand how to set the block trades right, me included, because we never knew what was considered big to a certain market, right? Like, how do we know that 50 contracts is a block trade that's worthy of having any merit in one market versus the next? You don't know that. Nobody knows that. The only thing that can tell us that is the tape. So what we do is we actually have an algorithm that scrubs the time and sales, like the absorption, and we compare all of the big blocks, not all of the orders, all of the big blocks, the top 10% of all, or even the top 1% of all big block orders. And then that tells us how to set the block trades. So what we do is we say, okay, take a look here on the NASDAQ. Average dynamic block size. Right now, it's telling us that the average block trade is 30 lots. So if I want to set a block trade on the NASDAQ to give me any merit, let me turn all this information off for a second so you can see it. Okay, turn off deltas, everything, just a completely blank chart. I have to go into the indicator settings, and I'm going to go set the NASDAQ. Okay. We'll set the NASDAQ at, say, 30 contracts. Got to go find it, guys. Bear with me. Block trades. Dynamic block trade size, 30 contracts, minimum block trade. Okay. 30 contracts. Give it a second to load. So we're setting the block trade on this for 30 contracts. So I'm going to go turn on block trades. Look at this. This is how you know that it's big information. Interesting. Let me turn off my trades here for a second, because now you have evidence that can tell you, let me just tell you right now, if this is not the sexiest thing you've ever seen, because I could set this to whatever I think is advocate. Like you could say, well, I'm going to set 20 lots as a NASDAQ. I could set it to 100 lots as a NASDAQ, but it's not relevant to that market information. So if you know all of the orders that are coming through the tape and you're able to set the setting based off what the tape is telling you now, that could be different tomorrow. That block trade could be a different setting because of the market. The market changes every day. You can have high volume days, low volume days. Blocks today might be different than blocks tomorrow, but I can assure you when we came to the value low, what did you see right there at the bottom? Big, big block orders going off on support. They tried to sell it, they retested, and then watch what happened here after the retest. What happened right there? That was the cue, man. That was the cue that set the tone for the big trend on the NASDAQ today. And you only want to be watching it coming in off support. You're not going to be paying attention to sell blocks on support. You're not going to be paying attention to block orders off the open either. Let the market pick its direction to an area, and there was the trend. Boom. You notice how we don't have a lot of them? You shouldn't. You shouldn't have a lot of big block trades. Let's go take a look at crude oil. Look at how many blocks you got going off on here on crude oil. Doesn't make any sense. The average block size for crude should be 44 contracts because that's what's going off on this market. So we can set the average block size in the indicator to 44. This took me about 7 years to figure this out stuff, guys. I'm giving you guys 7 years of experience here to help you guys figure this out. 44 contracts, minimum block size. Let's round that up to 50 contracts. 44 is the average block. Now we're talking. See how we have less? So what you want to do is you want to see buying coming in on key levels of support. You want to be selling coming in on key levels of resistance. And so depending on how this market traded very weird today, wasn't a lot of follow through on the market, but you can tell here that after those block came in, the market lifted after it. Okay, look back. You can change the look back. You can change the look back. I have it set to the last 50 bars because I'm not trying to go back too much data, but you can set it much larger, Robert. Absolutely. Yeah. This is quant filters, guys. We're actually scraping the time and sales to study the data as it's coming into the market. It's dynamic information. Same thing with big money print. Big money print is different here as well. We turn this on. Look at what happened at the highs. Look at how the market stopped and absorbed at resistance. Resistance came in. Where did the big money step in? They stepped in to absorb it. Right? And this is the whole point of understanding how to see that. That's just me just using the chart scale, guys. So you guys can see that it's just me, widening the candles. I can widen the bars. I can make them wider. I mean, it's just a graphics display, right? Just a graphics display. So the reason we do that is so that we can ultimately just be able to use the tools the way we want to without clouding up your charts, right? So a couple things I want to do here is I want to give you guys actionable evidence to take with you from today's event, okay? I'm going to give you guys some patterns. You can take some screenshots if you'd like, or if you guys want to come to our events, you can come to them in the future, but I want to explain this. The reason for today's event is to kind of give you information on evidence in the data, okay? We're following clues that we can't possibly do on our own. Order flow and volume will help us understand the bigger traders, because sometimes we get to a level, like let's say you have a level of support, and just because the market gets there doesn't mean the market's going to accept it. And that's the biggest thing that I've always seen with a lot of traders is that we have all this expectation that the market's supposed to hold off every level. That's not how the market works. You can have really, really high probability levels, indicators, software. It doesn't matter if it's our indicators or even other vendors' software. There's a lot of great tools out there. But just because it's a high probability level doesn't mean the market's going to accept it, which is the purpose of using this type of information to help you improve with your entries. Okay. And why would we want to use it? Levels can fail. Big money sometimes doesn't always come in and participate, right? Levels may not be exact. Remember, an area of interest are not always exact price levels. Sometimes the market will act in areas. Maybe they're going to overshoot support a bit before they come in, they rip out of it. It's never an exact science. Sometimes you have to have a little bit of wiggle room inside of how you trade areas of interest. One of the biggest things I like to do is I like to always have a process. So you want to have your levels. Check number one is you want to have your area of interest. Okay, so you want to know where you want to do business. You don't just want to take order flow and say, I'm going to be an order flow trader and just go out the gates and say, hey, order flow is amazing. It doesn't work that way, guys. You should have information that you want to assess. And then when the market gets to those areas, use order flow to help you. Unless you just want to be an order flow trader and just look at all the information all the time, then I would encourage you to master order flow by itself alone. But for me personally, I only look at order flow when I'm looking to take on trades and do business, because I'm a profile trader. So when I look at market volume profiles and I'm at key levels, I'm going into the information to see what's happening. And that's exactly what we did today in our trade room, is we used the order flow and we used the 1 minute cross entries to help us time the entries, and both of them were stellar trades. Okay. So what I want to do is I want to tell you about absorption. We covered this. Take a screenshot of this or watch the video when you get a chance with the recording. Absorption is when you're at areas of interest, not all in the middle of no man's land. This information up here is rendered useless. This is a support level. That information is important. This information here is rendered useless. We're at a resistance level. That information is important. That's the purpose of the discussion. You don't just rely on the tool set unless you're in an area that it makes sense to do so. Does everybody kind of get where I'm going with that? Okay, so this is an environment where the market will come to resistance. The buyers are going to push it up. The sellers are going to step in to absorb those buyers, and the market's going to drop. The market's going to come down. Boom. The buyers are going to be, or the sellers are going to be met with the buyers. The market's going to lift. Okay. And what we want to see is we want to see market orders come after that. We want to see market orders follow that. So that's the next step. We want aggression. After absorption, we want aggression. You do not want aggression before absorption. Aggression before, write that down. That is, I'm going to write that one down for you guys. This is super important. 1, find your area of interest. 2, locate absorption and block trades. 3, locate aggression. It's always, yeah, it works on any market. On NinjaTrader, this software is developed on NinjaTrader because of the custom development. A lot of you guys have asked about other platforms. We do have intentions on bringing lean versions to TradeStation and potentially TradingView. But guys, you're asking me to do some of the next things impossible. Sometimes you got to understand certain platforms are designed for certain things. Okay. So that being said, guys, we always want to find the absorption at support and resistance first. Okay. Very, very important. Okay, I'll give you an example. We get a pullback. We get a pullback here. Okay, market pulls back. Higher high in price right here. support. Market comes down to test the pullback. What do we want to see? We want to see buy absorption stepping in on the right-hand side, followed by market order aggression. That's going to tell you the market's ready to lift. You need to have that follow through after so that you can see that the absorption is starting here, but there's no follow through on the buyers yet. Absorption starting here, nothing happened yet. Kind of a little bit here. They came in at the lows. That would have been your cue. Now you can start to see the market orders, and up they go. That's the cue. Even here, buyers tried to step into the sellers, no follow through yet, nothing. Okay. So the main objective is to identify, first steps is always your levels, find the absorption. Then try to find aggression coming after the absorption so that you can understand what that tells us. Now, what you can also look to do is have delta confirm the bar that rotates. So when you have the market rotate from those levels and you get a flip of a candle and then the delta confirms it, delta comes next. You always have absorption, then you have aggression, and then you have delta. Okay, very, very important. Does this make sense? With aggression or with absorption. So delta with aggression, delta with absorption, it doesn't matter. Just making sure that you understand that you have that to help you. Okay. Net delta alone is very, very weak. When you have net delta with everything, that it can be very, very powerful. But I'm going to throw one little curveball at you. And I want to kind of leave you with this so that you understand why delta isn't the holy grail. And then we'll, I think that's about it, eh, Gilbert? I've thrown enough at the crew here. I think everybody's brains are about ready to roll over. But I can assure you this, you're in good hands. We'll take care of you. If you want to learn order flow, come to my trade room. I'll be using it tomorrow. Definitely use it to confirm entries. So let me talk about why net delta is not the holy grail. Because if net delta was the holy grail, then we would all be using it. Okay. So let's say this, right? Let's say you got market orders, right? And then you got limit orders. Market orders are aggressive, limit orders are passive. Let's say a really, really big bank. Okay, let's say a really, really big bank has a level up here. And they're waiting there passively, like for like 4 hours. Okay. What happens is when the market is going up, and it hits that limit order, software, the market doesn't know that it's limit order. Like nobody knows it's a limit order. It's just going off at the ask. You understand that? So if you have a limit order here, and then the market's trading up, all of this is aggressive buying. And then all of a sudden it trips that limit order here. Whammo. That is going to be a fake out. So a lot of traders will think that that's aggressive buying going into a resistance level when really that aggressive buying is not. It's triggering limit orders. And that's when you see those rotation flushes so quickly. It's because that limit order was a big limit order, and it trips the tape to make everybody think that it's an aggressive buying, and then everybody gets, that's the fake out breakouts. The fake out breakouts are when everybody starts buying, and then it hits a big limit order, and that limit order just says no way. And that's why you can't just rely on the delta to be the cue, because that delta is assuming that it's attributing that to the ask, but it really was sellers waiting to sell. And this is something that I learned this from a very good trader recently, and I felt it was something that I should teach this to my community. And it was something that me and Jeff had to wrap our heads around for a long time. We're like, okay, let's put this in a way that makes sense so traders can understand it. So just be very careful that if you know you've got a significant level, which should be selling, right? It's a key level, and you start seeing random market orders going off on the side of your candles like this, be very careful that at the tops of that area that it's not big limit orders getting hit and you get sucked into a squeeze. And if you come into my classroom, I'll help you identify that so you can see it. I'll give you an example on the long side. On the long side as well, you can see that a lot of traders would assume that that's a lot of sellers hitting the bid, when realistically that was a big buy limit order sitting down here at the bid, and it tripped as the market was trading down, tripped the limit, and then all of a sudden, whammo, the big market order squeeze comes. You see that? That's whenever you see that happen on an order flow chart, it's because the market hit a big limit, big passive limit, big traders sitting there with big orders. And that's when you get that really big flood of aggression, because the market just trips it. So I'll give you an example how to see that. It's hard to see it. It doesn't happen all the time. You got to look. It's not something that happens a lot, and when it does, it's really important to understand it. Great example of it. You see here, the market comes up. You get a bunch of buyers at the high. You see that candle up there, that 69 right there? You're assuming that that's market orders trying to trip at the ask. It's not. It's big limit orders getting hit, and then all of a sudden you get the flush of the market orders coming in on the sell side, right? So it's what you want to do is you want to look for those random bid and ask tripping at the lows and the highs of the candles. Like this is a great example. Great example of limit orders getting tripped at the bid. Right here. You think about this. You're at a support level. You're at the lows of the range. Think about where the market orders make sense. That's really important. Like anybody in their dog knows that any market orders triggering before the low breakout, like nobody's going to try to trigger market orders going into the lows before we're taking out the floor. Essentially, the market orders should be hitting here as they're taking out the floor. So when you start to see a whole bunch of orders going off, everybody starts thinking they're market orders. They're not. They're big limit orders sitting there waiting on the bid for support, and then all of a sudden it creates a short squeeze and then pop. So this is something of it took a while for me to study this and to learn this. It's not something that's going to come easy, but I can assure you that if you just look at key levels of support and resistance, and if you know that it should be support, and you start seeing a bunch of market orders triggering at the lows like that, and it's not truly at support, like support's down here, then that's limit orders getting hit, and that's going to create a squeeze. Same thing on the sell side, guys. It's not always a picture perfect science, but when you start to see big resistance levels, like if we know we have an area of resistance when the market should be at resistance, okay, like that, and you see this here at the top, you see that big 69 get tripped, and then you get flushed like that. Where are we? We're at resistance. You think the market's going to buy? The market's not going to break out on market until it trips the highest high. The market's not going to break out here. The breakout's happening at the highest high of that pivot, not sitting there inside that node like this. So whenever you see, that's a limit order being tripped, which makes sense because there's going to be sellers at the high, which is what creates this rotation. Boom.